two websites that are very helpful when it comes to investing that I actually used a lot when I was a financial advisor. And they're websites that everybody has access to. You don't have to subscribe to anything. The first one is known as Investopedia.com. It's got a search area there that you can just type in any word that has to do with investing and it'll give you the definition on that. The second website is Yahoo Finance. And surprisingly, the information that's available there to everybody is the same information that as a financial advisor, I used to have to pay thousands of dollars a year to have access to. Great website to get quotes on stocks, mutual funds, different things like that. It even has the charts on there are pretty good as well. So just yahoo.com, and then there's a little tab that says finance. This is Paul Mann, the Realty Man. 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 Oh, the Realty Man. And the Realty Man. The Realty Man. The Realty Man. The Realty Man. Hey everybody, Paul Mann, the Realty Man. Welcome to episode 4 of Ask the Realty Man. In about 1996, I, for some reason, started reading books on day trading, and more specifically, day trading stock options. And I actually became a stock option day trader. And I did that for several years, from about 96 until about 1999, and made some decent money, lost a lot of money. And another thing I realized is if I was really serious about being a day trader, I needed to find a job that would allow me to day trade full time. Found a company that was hiring people but had no experience in the stock market. So I got an interview with this company, went and sat down in this room, and there's 2 managers in this interview. At one point in the interview, they asked me, what's the difference between a stock and a mutual fund? I had no idea. In fact, I had no idea what even a stock was. I told them, guys, I don't know what a stock is. I don't know what a mutual fund is. But if you ask me anything about a stock option, I can tell you every strategy, why you would use different strategies at different times. Now, the whole reason I even tell this story is because what we're going to talk about in this episode is when you buy a stock, what does that actually mean for you as an investor? Even though it's kind of a basic question and the way I'm going to talk about it here is pretty basic, it's something that's important to know. So let's just say that I have a group of 5 friends. One of my friends' mom makes the best chocolate cupcakes. We decide that we're going to actually start a business, and our business is going to make these chocolate cupcakes. So we make a list of all the things that we need to start our business. We need an oven, some pans, and we need the little cupcake cups, sugar, flour. We need a kitchen, so we need packaging. So all these things, we've got this long list of all these things that we need, and we realize that between the 5 of us, we don't have the money to buy all these things. So there's a couple of options that we have. First one is we can go to a bank and we can get a loan. The second one, we can try and pool our money together and spend our own money. Another thing that we can do is we can sell bonds. Another fourth option we have is we can sell stock. We decide we don't want to go into debt. We don't want to have to be paying this bank back for several years, so we're not going to do that one. We don't want to pool our own money together, so we're not going to use our own money. Selling bonds and selling stock are definitely options. So after we make the decision that we're going to sell stock in our company, we come up with a name and we name our company JK Cupcakes. And in order to buy the things that were on that list that we need to get our company started and for future expansion, we determined that we want to raise $5 million. We determined that we're going to issue 1 million shares of stock. As any good business owner knows, you always want to hold control of your company by remaining the majority shareholder in the company. So the way we're going to do that is we're actually going to only sell 499,999 shares, which leaves us 500,001 shares. We're going to come back to this in a minute. For now, I'm going to put these shares up here. So these remaining 499,999 shares, we're going to allow those to go into what's called the float. Those are shares that are traded publicly. So we hire a firm who helps us register with the SEC and with the New York Stock Exchange. Our shares are going to go public at $20 a share. And they create what's known as an IPO, or initial public offering. And so what happens is they have a certain number of these 499,999 shares that they sell to their best clients at $20 a share. So these initial shares sell at $20 a share, which raises $9,999,980. Now remember, we had determined we need 5 million, so obviously we're way over our goal, which is good for us. Take the 5 million and use that to get the company started, and then we take the remaining 4.9 million and we put that in our bank account. We can take that money, we can split it between me and my 5 friends, use it for future growth. Either way, we've far surpassed our goal of $5 million. And then once it starts trading publicly, a lot of times there's so much hype in there that all these additional orders are on the secondary market or the stock exchanges, so that it drives the price up, so that it actually starts trading a lot higher than that $20 a share for the initial trades that start going through. So you've got their best clients of these firms that market our company, that get them at $20 a share, and as soon as it starts trading, they have an instant profit. We saw that happen a lot in the mid to late 90s and even the early 2000s before the dot-com bubble burst. If you have any questions, please comment below. If you have any suggestions about what you want me to talk about in a future episode, comment below. Thanks for watching. Like my videos, share my videos, do whatever you want with them. Please subscribe to my YouTube channel. Peace out.